What is the difference between trading and investing? Should I be a trader or an investor? What's the difference? Which one is better for me? If those are the questions you're asking yourself, then you are at the right place. In this video, we will give you some elements that will help you choose what fits the most for you, what is best for you, for your needs, your goals. Are you interested? Then let's get started. Even though trading has to do with stocks and other types of investments, it's really quite different from investing. Investors make financial investments with the hope of making a long-term profit. Traders buy and sell investments with the hope of a more or less short-term profit. So investors can invest their money to make profit over time, for example by investing in a company and betting on the growth of that same company, hoping that the business will keep on growing well, and that they will be able to profit from this growth. The timing can be 5 years, 10 years or more. Traders, on the other hand, are really short-term. They buy and sell stocks much more frequently, either on their own account or on behalf of the company that hires them for this task. Self-employed traders can do, for example, day trading or swing trading. With day trading, they buy and sell in the same day. They spend time buying and selling stocks, hoping to make money from the various market fluctuations. With swing trading, the trades are spread out over a longer period of time, so it's no longer a single day, it can be a few weeks, sometimes a few months, or even a few years. In order to better understand the differences between traders and investors, it is necessary to understand the notions of intrinsic value of a stock and the price of a stock. The price of a stock or the price of a share is related to the number of people who buy and sell a stock at a given moment. It expresses the price that allows the greatest number of buy and sell orders to be executed at a given moment, at a moment that can be defined in time. However, this price can easily be subject to imperfections. It can, for example, be strongly influenced by a generalized sense of panic during a financial crisis. In such a case, it may experience more or less sudden variations. These variations may be either up or down, and often disproportionately so. The intrinsic value of the share is the true value of the share. It indicates what the stock is really worth. However, it is not always easy to know the intrinsic value of a stock in real time. Here, the choices are mostly based on assumptions, and according to several rather complex elements. It should be noted that, very often, the price of a share does not always reflect the intrinsic value of the share. Indeed, there is often a difference between the price of a share and its intrinsic value. And it is on this difference that traders focus their attention. That is where they try to play to make a lot of money. This means that traders do not care too much about the intrinsic value of the stock. They focus much more on the price or cost of the stock, and they try to profit from the fluctuations of the stock price to make short-term profits. On the investor side, there are two main groups. There are what we might call passive investors and active investors. Passive investors do not care too much about the short-term fluctuations of the share. They focus on increasing the intrinsic value of the stock over time. That's why they may buy a stock at a higher price, a stock that is worth less than its current price, but knowing that over time they will make a profit. They hope that the stock price will change over time. Active investors, on the other hand, try to carefully analyze the intrinsic value of the stock, and they also take into account the stock's fluctuations. So, unlike passive investors, in addition to betting on the intrinsic value of the stock increasing over time, they also try to gain in the short term, by trying to buy only if the stock price is lower than the intrinsic value of the stock. Thus, they will also gain when the share price recovers. So the profit is double. And you, which do you prefer? Do you prefer to trade for short-term gains by betting on fluctuations, or do you prefer to be a passive investor who buys stocks over time and doesn't worry too much about short-term fluctuations? Maybe you find that the best option of the three is to be an active investor who profits in the long term and in the short term. Tell us in the comments which you prefer. If you learned something new today, then give this video a like and share with a friend. Manage well.